Hey everybody, Dave Brown with First Class Lending. Let's talk about a strategy that makes a lot of sense in today's home buying market. So we have an example here where we're going to compare a 2-1 buy down versus reducing the price. So in example 1 here on reducing the price, let's say a home is listed for $1,020,000 and you come in and offer $1 million, you get your offer accepted, you put down 20%. Rates are roughly in this range right now of 6.5% for that mortgage. And so your principal and interest payment would be $5,056. But what if we change things up a little bit? And instead of paying that seller $1 million, you actually pay them more, $1,016,000. Well, why would you do that? Because we're going to take that extra $16,000 and ask the seller for a credit. They don't care because they're still netting the same thing as if you paid $1 million. And we're going to use that $16,000 to do what's called a 2-1 buy down, where we buy down the interest rate 2% the first year, in this case 4.5%, 1% the second year, 5.5%, and then it's 6.5% thereafter, like you see here. So what would that result in? Well, you'd have a loan amount of $812,800 versus the $800,000, 20% of the little bit higher price. We have 4.5% and 5.5% as our interest rates, but look what happens to your payment. Instead of $5,056, you're at $4,118 the first year, huge difference. And in the second year, it's $4,614. So it's a nice way to kind of grow into a payment, especially if you're buying up in value a little bit. And the other thought is that we are projecting that interest rates are going to go down sometime in the near future. So hopefully before we even get to the end of this second year, we could refinance you permanently to a lower rate. And any of that $16,000 that wasn't used in the buy down goes back to you when you refinance. So it could reduce your loan amount or pay for the refinance itself. It's a very popular strategy. If you'd like to talk about this, give us a call. Thank you.